Hey everybody, Marty Missouri here, Friday the 27th of September 2024 with your weekly economic and market video commentary. Don't think I need to take too much of your time today. And by the way, clients, of course, it'll be Saturday morning when you're seeing this if you wait for the email link. But there is some important stuff to talk about. So I think what I'll do first is I'll touch base on our index score, then we'll work a little bit off of this week's written blog post. Maybe some things I want to add to that. We'll see as I get going. And then we'll run through some charts and take a quick look at stocks and the dollar. So to begin with, the PWA index has had two really impressive weeks in terms of things looking better from an overall macro or economic sense. We're still down or negative 11 points, which still says odds favor recession, or I should say recession risk is elevated on a go-forward basis, but less so. And I'll talk about how we've responded a little bit to that and somewhat to some news out of China this week. So with that in mind, let me pull down those of you who only watch the videos. Here's what I sent out, or I pinned on Tuesday, and it gets sent out the next morning. So China stepping up at least part way. Okay, so our internal discussions had us, we think, acknowledging the probability that China would be stepping in relatively soon with some perhaps more serious stimulus than they have of late. And so that was on Monday. And I talked a little bit about our core move here. We actually reduced our exposures to U.S. healthcare and to U.S. staples, which are, arguably the sectors you want to own when the economy is not doing so well. And what I said is here, marginally better odds of a soft landing based on the Fed's aggressive start to the easing cycle and recent improvement in the PWA index. However, our base case remains better than a 50-50 go-forward odds of recession. Therefore, despite the cuts in those sectors, staples and healthcare remain top weightings, as do T-bills and as does gold. We increased our emerging market equity exposure, which a good chunk of the ETF we increased has China exposure. It reflects the improved prospects for a near-term weaker trending dollar, which would be consistent with the Fed reducing interest rates and no recession on the ground just yet, as well as China's historically weak valuations and the likelihood of Chinese policymakers stepping in over the next 12 months. That was from our more extensive than this internal narrative about the changes that we made. And then, of course, I copied and pasted this from Monday. It was actually Tuesday when I was writing the blog. Well, I guess I should have said the next 12 hours. They stepped up last night. Here are the details. The PBOC cut its reserve requirement ratio to 9.5% from 10, freeing up 1 trillion yuan, or 140 billion in US dollar terms. Cut the 7-day reverse repo rate. There was a 50 basis point drop in the average interest paid on existing mortgages. There was a cut in the minimum down payment to buy any home, even a second one, to 15%. Previously it was 25%. The People's Bank is creating a 500 billion yuan swap facility, which would lend money to funds, insurers, and brokerage firms specifically to buy stocks. So no wonder the stock market had a good week. There's also another re-lending facility of 300 billion yuan to give commercial banks that would in turn lend the money to companies specifically for stock buyback. So clearly they're trying to put a floor under what has been a tough stock market environment of late. And then I said that the PBOC made it clear that more easing is to come. So while this is huge for Chinese equities, right, based on those last two bullet points, the consensus among the economists we respect is that there's a technical opportunity here to game, an oversold bounce in Chinese equities. But until they step in with fiscal measures, consumption stimulating fiscal measures, their economy and markets will not see sustainable improvement. So while I get and agree with regarding the need for fiscal, where they're coming from. I don't believe we should rule out the prospects for fiscal stimulus to follow as we meander into next year. Now, ironically, that night there was another announcement, and this came out of the Politburo meeting in China, where they took a break from their traditional political calendar, no doubt motivated by deteriorating economic circumstances. New situations and problems, where in July they spoke of new momentum and new advantages, it resolved for the first time to try to arrest the property market's fall, and it promised to make countercyclical policies more potent. So essentially what they said is bond issuance amounting to 2 trillion yuan, equivalent of 1.5% of GDP, half of that will help diffuse the risk that local governments go broke. The other half will encourage spending by households and firms. Essentially, they're looking at giving away money, and we've learned about that in the last 4 years right here in the U.S., right? So it'll help finance a monthly handout to expanding families, about 800 yuan per child. According to the 2020 census, 114 million children could benefit. So, long story short, looking for an excuse to basically pump money into the consumer sector, get them spending, get them feeling better. And, we'll see. But again, coincidentally, here I am saying they're going to need to step in with fiscal measures, and lo and behold, it was that night that they did. So needless to say, we're feeling pretty good about that addition that we made to emerging markets equities. We'll see if it's sustainable. We do know that valuations, and I should have loaded up my valuations chart. Maybe I'll do that for next week, and I updated that this week. The rest of the world is just historically cheaper by most valuation measures than is the U.S. So from a pure valuation standpoint, we're looking for, during the next expansion, for emerging markets to potentially notably outperform U.S. equities. So we like that on a long-term basis, and because of what we anticipated, which actually has begun to happen, there's more that they need to do, but it's begun to happen sooner than I obviously expected, although we did make those shifts right before it all took place. Okay, so interesting stuff, no doubt. Talking about the second largest economy in the world, something we pay very close attention to. Okay, so quickly, the personal consumptions and expenditure data came out this week. Consumer spending, or personal consumption, rose 0.2%, and that was just slightly off of expectations, which were up 0.3%. And the spending increase was 100% in the services space. Spending on goods actually fell month on month. As for personal income, it grew at a 0.2% clip, and the estimate was to be up 0.4%. So again, while these aren't contracting, you can see the rate of growth isn't quite as good as was expected. Consumer confidence, both the conference boards and the University of Michigan's came out this week. You can see that the conference boards actually ticked down overall, while the University of Michigan's ticked up. Interesting, obviously asking different people different questions. Nevertheless, on balance, I would say sentiment has improved a bit. Certainly it has, as you can see these trends where we're seeing higher lows. Durable goods orders came in as expected, but as you can see, nothing at all to write home about. Truck tonnage, it continues to improve, so that's the amount of goods that trucks are carting across U.S. highways, so that's a positive indicator. The Chicago Fed National Activity Index ticked up a little bit here as well, back slightly into the green. The deflator, PCE, inflation measure, this is the one the Fed supposedly looks at more so than CPI. As you can see, it continued to drop. The market liked that. Futures were red on the day. They turned green at 8:30 Eastern time this morning when this number came out. Later in the day, though, they turned red again. At least the S&P and the NASDAQ were red on the day. The Dow was up a bit. Core PCE, though, which excludes food and energy, you can see that actually ticked up a little bit to 2.7. And on a month-on-month basis, the PCE dropped 0.09. So definitely the inflation cooling, getting close to the Fed's target, and in their minds justifying their fairly aggressive start to their easing cycle. Now, on the other hand, we've got a really nice pop here in the Bloomberg Commodity Index. I think you can largely thank China. China is the world's largest commodity consumer, and when their government says, "Hey, we're gonna boost the economy," then instantaneously commodity markets react to that. The metal with a PhD in economics, they say, hence the title Dr. Copper. You can see they have been booming here of late. And every time I talk about copper, I talk about China. Of course, that explains this last big thrust right up in here. But copper has suddenly gotten very bullish. And again, these are positive signals about the overall economy as well. And certainly if the world's second largest economy is beginning to stimulate, now the full projected impact of the stimulus so far doesn't move the needle a ton. I'm interested in the trend. I'm interested in the fact that after the Politburo meeting this time, they didn't mention concerns about moral hazard and giving money away. Those terms were taken off of the official statement. That tells me that they may be a bit more serious about doing something more sustainable with maybe larger increments as we go forward over the next few months. That consumer staples to consumer discretionary ratio that I talk about here often, again, when this is going up, consumer staples, which are very defensive, they make the things people have to buy, versus consumer discretionary stocks, when they're outperforming to the tune of 14%, that says something very scary potentially about the economy. Well, now they're only outperforming by 2.6%. And that reflects what we've been saying, is things have been looking less bad of late. Does not mean that a recession isn't coming. And I've shown you here more than once how we do tend to get these bounces in economic data right before recessions historically. So that may very well be what's happening here. But we've got to read it for what it says right now, and the conditions on balance are a bit less bad. Now, having said that, now global PMIs this week were not good, and the U.S. PMI was not good at all in the manufacturing space, and a little less good in the services space. So despite what we're seeing here in our inputs, some of the soft data, specifically the S&P's PMI data, is actually questioning this improvement that we're seeing right here. Okay, and then lastly, and fairly quickly, because not a lot's changed here, let's take a look at the S&P 500 daily chart. I do have a different screen down here for you just to take a peek at. So here is the S&P moving into new all-time high territory, right? Breaking through that resistance, testing it here, and nothing too inspiring from a momentum standpoint, and that's a bearish rising wedge pattern. One thing I wanted to point out, though, is the on-balance volume actually rolled over pretty hard while over these last few days we were making this rush into new all-time highs. Now, on-balance volume, we've looked at that many times over the years, just simply captures and accumulates the number of shares traded in a given day and moves a line in the direction of the move. So meaning that we have an up day, albeit a slight up day, all the volume is going to show up moving up. So obviously it's not a perfect indicator, but long term it tends to give us signals. Notice back in here before that correction that got everybody's attention earlier this year, notice that the on-balance volume had been rolling over into that, at the time, all-time high. Here we are now. You can see that's quite the bearish divergence. And so, just something to talk about. Has my attention. Just another indicator that we should not necessarily let the pigeons loose yet on this latest move to all-time highs. And then, of course, on the momentum indicators, it's just the same, folks. Bearish divergences, I told you we would not be able to burn through these if and when we got here. So this just says the market's heavy and prone to roll over. Not a sell signal. We can meander a long time and just kind of continue to melt higher. The technicals, and I won't show you this week, but I've been showing you the weekly chart, actually looks more ominous to me. In terms of the NASDAQ 100 or our ETF here that tracks it, as you can see, we don't have bearish divergences off of this area, but we will off of this all-time high if we get up here in the next few days. So again, not an inspiring chart if you're a long-term investor. If you're a swing trader, I think there's all kinds of opportunities in there. And then lastly, the dollar. we're back to that correlation where weak dollar is positive for stocks, certainly positive for commodities this week. And, we've been talking about this and the likelihood, if the Fed cuts interest rates and so forth, particularly if the places like the Bank of Japan raise interest rates. They just announced they're going to have a new prime minister. Our yen position today actually saw quite the rally. I think we were up like 1.75%. We've been long the yen here for a few months because it got so depressed and the world was shorted. So we figured that this thing really, and from just a fundamental value standpoint, is grossly undervalued. So it made sense to own the yen. If we have a recession, the yen will be a safe haven currency, I think even more so than the dollar. So we want to definitely own that. It's been good for us so far. But anyway, my point here about the dollar is that I think the world's fairly bearish on the dollar right now with Fed policy. This chart is telling me that maybe we shouldn't be so bearish. We have a falling wedge pattern, and we have notable divergences on both the MACD and the RSI. So the dollar could see a rally. So what would make the dollar rally? It would be continued better than expected economic news in the U.S., and that would lessen the prospects for aggressive Fed rate cuts. So interest rate differentials then would suddenly favor the dollar relative to what's expected right now. To really do a deep dive, we'd have to get into what's going on in Europe and in the other countries. But for today's monologue, I think I've taken enough of your time, and I hope that was helpful and interesting and somewhat instructive about where we sit and clients, why we're managing your money the way we are. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend. Talk to you again next week. Bye-bye.